In today's video, I'm going to show you how you can increase your after-tax portfolio return without taking more risk or without really changing your asset allocation at all. Now, how is this possible? Well, we are going to invest with a tax-first mindset and use an approach called yield splitting. To understand this powerful concept of yield splitting, it's first very important to understand something called asset location. And yes, I'm saying asset location, not asset allocation. So asset allocation is what you ultimately hold. Your asset allocation will determine your risk to return profile. But asset location is not what you hold, but where you hold those given assets, what accounts you hold those assets in. Now, this seems like a minor thing, but it is a huge deal in the investment optimization game. Let's go through an example to show how important asset location is. On the screen, we have a couple that has accumulated $1.6 million in retirement assets. Now, the majority of these assets are located in a tax-deferred account with a little bit in a Roth account as well as some within a taxable account. Now, pausing here for a second, if the couple in this example has too much in assets to compare to your situation, or maybe too little in assets to compare in your situation, we can easily scale these assets up or down, but the same exact principles will apply. Now, this couple is using a very simple three-fund portfolio of US stocks, international stocks, and bonds. And as you can see on the screen, this allocation essentially equates to a 60-40 portfolio. Now, a big mistake that I see from a lot of retirees is they'll simply hold that overall allocation in every given account. Now, this seems logical on the surface, but is actually a pretty big mistake. The problem here is we're not considering taxes. Each retirement account that you have has different tax implications. For instance, your Roth IRA will never be taxed again, regardless of how big it grows. And so we want the most growth out of this account because it will be tax-free growth. Your traditional IRAs and other tax-deferred accounts are tax-infested accounts. When we pull income from these given accounts, we will owe ordinary income taxes, which are relatively high, all things considered, within the tax code. Not to mention, these accounts have required minimum distributions that start at age 72, where you will be forced to take from these accounts whether you want to or not. As you've seen from many videos on our channel, this account can be the biggest tax burden within your retirement. It can push you into different tax hurdles that you may face. Now, because of this, we want this account growing as slow as possible relative to your other accounts. Now, your taxable account is a bit more complicated. If we're managing this account properly, when we pull income from this account, we will be subject to long-term capital gain rates, which are a preferred rate to income rates and are lower at every given level. This account can also be a great estate planning tool because right now, when you pass that account on to the next generation, they receive a step up in basis. But this account can also be a very leaky bucket if you're not careful with how you manage this account. For instance, if you carry bonds within this account, all of the interest that you earn on those given bonds is taxed at ordinary income rates. So we're no longer using the benefit of the long-term capital gain rates. We're now subject to those ordinary income rates. This will affect our growth and be a tax drag on this account. Dividends are also a tax drag on this account because they are essentially forced income. If we take a dividend, we pay the taxes on that dividend, and then we reinvest that dividend within that taxable account, we've now just hampered our future compounding growth because we basically took income, paid taxes on that, and now we're investing a smaller sum. This dividend tax drag can add up and be a fairly big tax drag on this taxable account. Because of these tax implications, here's a more optimal way to locate the assets in each one of these given accounts. Well, notice we're focusing on growth within the Roth IRA because we want that tax-free growth. Focusing on tax efficiency within the taxable account by leaving out bonds and trying to maintain a low dividend yield within that taxable account. Then within the IRA, we're putting all of the safer assets that should translate to lower growth, as well as the more tax inefficient investments. Now, this might seem strange. We made their overall portfolio picture a little bit more complex. Now, they're still holding the same portfolio allocation, but the asset allocation in each account will look slightly differently. And this is because we're optimizing for taxes, not simplicity. Now, I want to make sure everybody understands here that we're not changing the overall allocation. We're still staying with a 60-40 portfolio. We're just changing the location of each one of those given assets. And so there's no performance difference here, but yet the after-tax results are significant. Now on the screen, you will see the after-tax values of putting a 60-40 portfolio in each given account. Now you'll notice that the IRA is the largest asset by a wide margin here. And in order to get to that after-tax value within that IRA, this couple has paid a lot in taxes. Now here's what it looks like when the couple locates properly. Now you'll notice the values shift quite drastically. For instance, we see the IRA shrinks while the Roth and taxable account balloon. Overall, when we add together these after-tax values, we'll notice that asset locating properly results in about $610,000 more in after-tax value. From a percentage standpoint, this translates to approximately 0.24% in after-tax return on an annual basis. Now this is all just from simple blocking and tackling. There's no performance difference, just logical asset location. But we aren't done yet. Let's take this one step further. In the big picture, I'm a huge fan of simplicity, but only to the extent that simplicity benefits us. At times, there's no other way around it. Simplicity can actually cost us. For instance, we used a 3-fund portfolio earlier, and that's a very basic and simple allocation that I see a lot of retirees use. But we could take this simplicity one step further, and we could actually find one fund that encapsulates this 3-fund portfolio, but all in one fund. But as we showed earlier, if we just hold that one fund, we don't have any ability to asset locate properly. We'd be forced to hold that one fund in each given account. And thus we'd miss out on all of the benefit from location. Now this same idea applies to that 3-fund portfolio. If we break that 3-fund portfolio up into smaller components, we will gain additional opportunities to asset locate. This is something called yield splitting. For instance, let's break down that US stock allocation further into large cap value and large cap growth, mid cap value and mid cap growth, small cap value and small cap growth. For illustrative purposes, you can see the variations in the returns as well as the dividend yields that we're using for each sub-asset class. You'll notice that growth-based asset classes have a much smaller dividend yield than value-based asset classes. Now, once again, it's important to note that when we prorate each of these given sub-asset classes together, we will arrive at the same return and dividend yield as the overall US stock allocation. So we haven't changed anything from a performance or dividend yield standpoint. But breaking down into individual components gives us the ability to locate even further. So now we can put the higher growth and higher dividend assets within the Roth IRA. We can look for the more tax efficient assets within the taxable account, things with lower dividend yields. Subsequently, the after-tax results get better. Now, when we compare to the baseline portfolio of that 3-fund portfolio of allocating a 60-40 to each given account, we see an almost $860,000 improvement. And so we see that even though we're still maintaining a 60-40 portfolio, this yield splitting adds to the after-tax benefit. Now, this translates to add an additional 0.33% in annual after-tax return and adds about 0.09% or 9 basis points on top of the previous optimal asset location strategy. Now, we could take this concept even further and apply this to other asset classes as well. So we could take the bond portfolio that we're holding with about a 40% allocation and break that up into smaller components as well, taking everything from a short-term treasury all the way to a high-yield bond. Now, the higher yield that we'd be receiving on a bond, the higher tax cost of locating that within our taxable account. So we'd want to be thinking about this through that tax lens as well. You could also break up your international portfolio into growth as well as value, or break up even further and look at international developed versus international emerging markets. Once again, by yield splitting further, by breaking up into smaller components, we will have additional abilities to asset locate. Now, thus far, we've been just looking at yield splitting through a pure growth lens. We haven't been looking at withdrawals from given accounts. And withdrawals from given accounts can completely change this yield splitting idea. For instance, if you're taking income from your taxable account, we can't be 100% stock within that taxable account. What happens when stocks are down, let's say 30 or 40%, and we still need that given income? So now we need to add safety. But as we discussed before, adding safety in certain ways can be more advantageous than other ways. So for instance, within that taxable account, we really want to try to control the yield because that yield will have a tax cost. If we have an investment that has some high interest within that account, we will be taxed at ordinary income rates. And now we're leaving behind some of the benefit that we could be attaining with that taxable account. And so we'd ultimately like to hold lower yielding assets, like again, short-term treasuries within that taxable account that will provide the safety, but still be keeping that tax drag capped. So ultimately, the best way to asset locate and yield split your portfolio will vary person to person. Here are a few questions you need to be thinking about. Which accounts will you be withdrawing income from, and how much will you be withdrawing at any given time? Are you performing annual Roth conversions? If so, where are you paying those taxes from? What is the goal with your assets? Are you trying to leave a significant amount to the next generation? If so, certain accounts are better to be left as inheritances. Finally, what is your goal asset allocation and why? All of these questions will certifiably change your asset location strategy. Simplicity is great, but we see based on these examples that moving a little bit more towards complexity can have a clear advantage. Another somewhat complex decision that you need to make in your retirement is when to harvest income in the 0% brackets that are available to you. Now, we previously recorded a video that can give you a blueprint for this exact decision. Too often I see retirees make mistakes and harvest tax-free income at the wrong time. Click here to see what I mean, and always remember you don't need more money, you need a better plan. Thanks for watching.